Analyzing the short-term performance of the US dollar and its technical indicators. When examining the short-term performance of the US dollar and its technical indicators, several factors come into play. Firstly, it is essential to consider economic data and events that have an impact on the currency's value. This could include the release of key economic indicators such as GDP growth, inflation rates, and employment data. Additionally, changes in interest rates by the Federal Reserve can have a significant influence on the US dollar's performance in the short term. Another crucial aspect to analyze is the technical indicators of the US dollar. This involves studying charts, patterns, and trends to identify potential levels of support and resistance. Technical indicators like moving averages, oscillators, and relative strength index (RSI) can provide valuable insight into the currency's short-term performance. It is also important to consider market sentiment and investor behavior. Factors such as geopolitical tensions, trade disputes, or political developments can impact how investors perceive the US dollar's value. Consequently, shifts in sentiment can lead to short-term fluctuations in the currency's performance. Lastly, it is worth noting that the US dollar's short-term performance is also influenced by its relationship with other major currencies. For example, changes in the euro, yen, or pound can affect the US dollar's value. Consequently, analyzing cross-currency correlations and assessing the strength and weakness of other currencies is crucial to gain a comprehensive understanding of the US dollar's short-term performance. In conclusion, when analyzing the short-term performance of the US dollar and its technical indicators, it is crucial to consider economic data, technical analysis, market sentiment, and the currency's relationship with other major currencies. By taking into account these factors, investors and analysts can make more informed decisions and better understand the short-term movements of the US dollar. The significance of hidden debt and rising interest rates on the US dollar. In recent years, there has been a growing concern about the impact of hidden debt and rising interest rates on the stability of the US dollar. Hidden debt refers to the accumulation of debt that is not publicly disclosed or accounted for in the government's official figures, including unfunded liabilities such as Social Security and Medicare. This hidden debt poses a significant threat to the US dollar as it can lead to a loss of confidence in the currency and increase the risk of a fiscal crisis. The rising interest rates further compound the problem by increasing the cost of servicing the national debt. As interest rates rise, the government's interest payments also increase, putting additional strain on the budget and potentially leading to a larger deficit. This can have a detrimental effect on the US dollar as investors may become wary of investing in a currency that is burdened with such high levels of debt. The significance of hidden debt and rising interest rates on the US dollar cannot be understated. The US dollar has long been considered a safe haven currency, but these issues threaten its status and raise concerns about its future stability. If not addressed, the consequences could be severe, including a possible devaluation of the currency, a loss of reserve status, and a weakening of the US economy. In order to mitigate these risks, it is crucial for the US government to address its hidden debt and take steps to reduce its overall debt burden. This can be achieved through fiscal responsibility, including measures to control spending and reduce the deficit. Additionally, the government should carefully manage interest rates to prevent them from rising too rapidly. By taking these proactive measures, the US can safeguard the stability of the dollar and maintain its position as a leading global currency. The potential strengthening of the US dollar, deleveraging, intervention, and inflation considerations. The potential strengthening of the US dollar has become a topic of interest in recent times, particularly due to factors such as deleveraging, intervention, and inflation considerations. Deleveraging refers to the process of reducing debt, which has been a significant concern for many countries, including the United States. As countries strive to reduce their debt burdens, they often sell assets denominated in foreign currencies to raise funds, which can lead to an increase in the value of the US dollar. This can further strengthen the currency as it becomes more desirable to investors seeking refuge from economic uncertainties. Intervention by central banks is another factor that can impact the strength of the US dollar. In times of economic turmoil or to address trade imbalances, central banks have the ability to intervene in currency markets. By buying or selling their own currencies, they can influence exchange rates and potentially strengthen or weaken the US dollar. This intervention can be a deliberate strategy to control inflation or stimulate economic growth. Inflation considerations also play a vital role in the potential strengthening of the US dollar. Inflation erodes the purchasing power of a currency and can lead to its devaluation. However, if the US Federal Reserve implements tighter monetary policies to combat inflation, it can result in a stronger US dollar. Foreign investors are more likely to invest in a currency that offers higher returns and lower inflation risks, further driving the demand for the US dollar. Considering these factors, the potential strengthening of the US dollar can have significant implications for global trade and investment. A stronger dollar can make imports cheaper, potentially benefiting consumers but hurting exporters. It can also influence the competitiveness of US companies in international markets. Overall, deleveraging, intervention, and inflation considerations are crucial factors to monitor as they can contribute to the strengthening of the US dollar and shape the global economic landscape. The impact of hidden dollar debt on currency strength and inflationary risks. The presence of hidden dollar debt within an economy can have significant implications on both currency strength and inflationary risks. Hidden dollar debt refers to debt denominated in US dollars that is not easily visible or accounted for in official records. This type of debt is often held by corporations, banks, or even governments, and its existence can pose considerable risks to the stability and health of an economy. One of the key impacts of hidden dollar debt is its potential to weaken a country's currency strength. When the amount of hidden dollar debt is substantial and its existence becomes known to the markets, it can trigger a loss of confidence in the currency. Investors and market participants may anticipate difficulties in servicing the debt, leading to a depreciation of the currency. A weaker currency can, in turn, increase the cost of imports, contributing to inflationary pressures within the economy. Furthermore, hidden dollar debt can also heighten inflationary risks. As the currency weakens, the cost of imported goods rises. This increase in import prices can lead to higher costs of production, ultimately passed on to consumers in the form of higher prices for goods and services. Additionally, the depreciation of the currency can also spur inflationary expectations, as individuals and businesses anticipate further price increases in the future. This can create a self-reinforcing cycle of rising inflation, eroding purchasing power and decreasing economic stability. In conclusion, hidden dollar debt has a substantial impact on both currency strength and inflationary risks within an economy. The presence of such debt can weaken the currency, driving up import costs and contributing to inflationary pressures. Policymakers and market participants must closely monitor and address hidden dollar debt to mitigate the potential risks it poses to economic stability and growth.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.